Welcome back to the podcast videocast. My name is Darson Grantham, real estate agent and investor here in Des Moines, Iowa. And I have, as always, Jared with me. Jared, go ahead.
Jared Huseman here, president of the Catalyst team, part of KB Commercial Realty, multifamily broker specialist here in the state of Iowa, working across the state now in Davenport, Cedar Rapids, Bettendorf as well, and Des Moines here, which is our main office focus here. And as always, we're just here talking about real estate, business, investment, a little bit self-growth sometimes, I guess, and just kind of giving our perspectives on the market.
And today we're going to just talk about the differences, the data behind the market, what's happening. We don't have any specific topic other than a couple data points that I found and wanted to, just discuss. And Jared had a couple data points in our different perspectives on what they mean to both buyers and sellers. But first, let's dig into any recent sales or anything that just jumps out of I can't believe this happened, or conversations that you've had or anything like that.
Yeah, so I guess the one I can say pretty confidently here is that we're just rolling out our quarter report right now for second quarter for multifamily. Darson's mentioned before, and if you want, you can get on our list. Email me, whatever it is.
Get on that list.
It's a pretty good quarter report. It's pretty well followed. But we're putting the data together for that. And the interesting part is, and we try to do our best to sort data. It's not always accurate, but we have about 89 million of sales volume for multifamily in central Iowa. The reason that's important is that there was one sale with $65 million. It was the largest apartment sale in the history of Iowa by sheer dollar amount, not number of units, but sheer dollar amount was the highest ever. So do the math.
In quarter two.
In quarter two, it was the downtown. It was the Hanson portfolio sold to Miami Group. It was a family-run investment group. Ball Yard Lofts, City View, and Eagle View Lofts, and townhomes. Anyway, $65 million. It was about 300 units or so. But again, do the math. $89 million of sales. 65 million of that came from one. So we only had about $20 million of sales this quarter, give or take. Maybe a little more. We still got all the data rolling in as well. And there might be a few ones we missed. But we're talking $20-30 million of sales volume, when the first quarter we had over 100 million, 117, 140 million.
First quarter we had 117 million or whatever, 140.
Right.
What was, do you remember last year, putting on the spot, 2021 Q2?
So it's funny you say that, because last year, I always put that in my quarter report as well, so you can kind of track some of the stats. And last year, quarter two, we did see a very slow quarter at only 70 million of sales volume. But if you take away that second quarter, out of the last 6 quarters we've seen, the last year and a half, multifamily, we have not seen this slow of a quarter. So basically since COVID. Okay. Since COVID, we have not seen this low of sales volume for apartments in central Iowa. So that, and again, if you take away that one sale, it's drastically slowing down. So the numbers, just back to stats, don't talk about stats. I mean, interest rates going up are affecting sales. What we're seeing in the multifamily space is sellers are saying, I'm going to hold out for my price. I'm not going to reduce it. And they are just willing to take longer on the market and wait for the offers. And buyers are really looking at what's this market look like, what's the economy, and they're very, very skittish right now. So we're seeing a very slow, I think, sales transaction right now. Not saying pricing has fallen yet. I have seen a little bit of pricing fall off a little bit, but we are seeing buyers be more cautious right now for multifamily. So
yeah, and we'll get into that, the velocity here.
The velocity, yeah.
So conversations I've had, I was tipped on an apartment that was going to go up for market rent. I'm not apartment. It's 11, around 11 units, right? It was a decent little deal. And they bought it in 2018, 19, and gave me the numbers, and they didn't make any sense, right? And the property had new leases, but had pro forma rent another $100, $150 above the new lease rent. And to me, and I asked the agent, I said, hey, agent, what's the deal here? This is what I'm seeing. Doesn't make any sense that they'd be under market rent when you just renovated everything and leased everything out. And they're like, yeah, you just must not be looking at a good deal or looking for this deal. And I was like, well, that's a little weird. So I went back and looked at all the properties they bought. This was in a package of other properties they bought, right? And so they're trying to just skirt out and get out of that. And I think my guess is that was a 2019 purchase or 20 purchase. I think you're going to see more of that. People that are just willing to maybe break even because they bought a property, in 19, 20, a little maybe overpaid. I've seen it on the residential side, much more common on residential than I have multifamily, just because there's more volume there. But So interesting, just things to pay attention for and look out for. It probably happens in every market. It's news to me, and it just hasn't happened for a while.
So this ties back into what we want to talk about today, some stats you were talking about here. But as I've been looking at the market as an advisor and agent, I'm just tracking this here. One that I've noticed, specifically in the last year and a half, again, back to the last 18 months I just mentioned, we have seen more owners who bought property in 2017, 18, 19, flipping it for more profit in a 2 or 3 year period, basically there, and getting out. And if you look at it, it is purely cap rate compression. The rents are almost exactly the same. The pricing is higher just because cap rates and rents went up, but these properties were not making sense a couple years ago, and they're getting out. And I bring this for a reason is that, back to where we want to talk about today is velocity. I've seen more investors flipping deals every 2 or 3 years and 5 years as opposed to actually holding for anything long term, which for our market in Iowa is unheard of. Typically, we've been a buy and hold market for a long time. I'm not saying you cannot do this, you can't make money at it, but typically the whole buying and selling every 3 to 5 years is done in primary or secondary markets, not tertiary markets like Des Moines, tertiary markets. And I've noticed that as well very heavily in the last couple of years. And it's increased our sales velocity as well. Yeah. And again, it's also increased a lot of these. I mean, I think we're talking about here, and I'll kind of
go ahead. Let's dig into it.
But I mean, 2021, we saw over 500 million of sales volume for multifamily apartments in Central Iowa here. That was like 200% increase from 2020, where we had 200 million of sales volume, and that was still a record year. Normally, we see 60, 70 million of sales volume. We started breaking into the 100 million.
For the entire year?
For the entire year. We started breaking into $100 million numbers in 2015 and 16 and 17 in that area. We started breaking those $100 million numbers. But again, 2020 was a 200% growth almost from 2019, where we saw about 120 million. And again, we saw a massive number come up in 2021. So again, sales volume, and people are flipping every couple of years.
Yeah, so the kind of premise of the topic we want to talk about this week is velocity, right? So the speed of units sold, not necessarily volume. So we'll leave price out of it, but really just number of transactions. And so I ran a statistic, and my coach has been pushing me on it. Hey, try to find out how many owner-occupied versus non-owner-occupied sales happen. And I've been struggling to figure out how to figure it out. And so I finally found a way to do it, and I ran it, and I thought I ran it wrong, is how crazy the statistic was. So 2017, 18, 19, the non-owner occupied sales were around 730 to 780, 730 to 780. This is Polk and Dallas County. And then 2020 hits, and it's 1,738 owner-occupied sales, non-owner occupied sales. So you had an increase of about 1,000 units, 1,000 addresses, not units, sorry, 1,000 addresses that sold that were non-owner occupied. Right. They might have went non-owner occupied on the sale, the second end, but like that's a drastic increase. 2021 was about the same number, and then 2022 we're at 650 halfway through the year to date.
And that was on and maybe tell me this too, but so you went from 730, give or take, non-owner occupied sales to 1,700 non-occupied sales. Yep. Was that then investors actually selling their property? Or was it actually buyer? I mean, can you tell whether it was a seller buyer?
It was one property transaction. Right.
So one side of that was a non-transaction. Was either it was an investor selling to the general market and unloading it, or it was a buyer buying it to make an investment property. Right. It's one of that, but you don't know which side.
You don't know
correct?
which side. Yep.
Okay.
Yep.
But you still was. It's still
it started. No, it's not owner occupied sales. So it had to been. It started non-owner occupied. Right, and then it sold. Whether it sold to another non-owner occ or an owner occ.
So what that means is, if I'm hearing and understanding correctly, this for everybody watching, is that investors then were saying, "I'm tired of renting this property out. It's time to sell this," because we saw this huge pricing.
Yep.
Right.
Yep. To me, that says like everyone who was holding a property because they just were holding it because something happened in the last 10, 12 years that they turned a primary into a rental, and they were like, well, I'll just hold on to it. Numbers work. It's fine with me. The appreciation goes up and up and up. 2021 hit, and they're like, screw it. This is it. Let's just sell it and see what happens.
Yep.
That's what I'm reading. Also, the investors flipping and turning, right? So that's a huge number. I mean, obviously, the number of investors is tiny compared to the number of residential sales in general. But I think that has a lot to do with it, too, that velocity.
This to me just brings up two things I want to think about. And this question that I don't have answers for, we can talk about it though, is my first question is that's a lot of supply that's on the market for rent. Maybe that's why we're seeing a lot of these landlords who do own housing see a lot of their rent jump up, because also we took up 1,700 units that were now being rented to the general public that are now no longer on there.
1,700 property addresses. So
Yes.
it could be more than, I mean.
It could be more.
Yeah.
But again, think about that
yes.
then. If you are an owner of residential single-family homes or duplexes, and I talked to one the other day that he said his rent was crazy high, he couldn't believe it. But maybe he's seen also the huge rental growth because we just took that huge supply of rental out of the market. It's all went to owner-occupied people. That's my first question. I don't know maybe it is the answer.
I don't know. Well, we'll just dig into that. Can you hold those other questions?
No, yeah. Let's dive into it.
What I'm seeing in the home, like a single family home rental market, it is, those rents are increasing like crazy.
Yeah,
like
100%.
There is no question there. The properties that are for rent are crappy, or they're very high rents, and they end up getting rented.
Yep.
Right. Like I mean, I'd have to talk to a couple property managers to really verify that, but I try to pay attention to the market of like what's actively for sale or for rent. You know, what are those high end? Are those A, B, C class properties? What does that look like? Because I do have a set of investors that are like, we'll take a B level, a Clive $300,000 house and rent it out for $2,500. Like, seems good to me.
This is why I've been bullish on housing for a couple of years now. I've been saying I see more value in housing, and I know, for example, I had an owner own a bunch of A-class townhomes 6 months ago and was considering a sale, and he decided he wanted to keep them because he goes, I see more rental growth coming in the market right now as well, maybe for this reason. The other thing this makes me think about here, as we talk about our velocity in the market here, and again, this is more for you, I'm throwing the question to you, is we also just saw, again, based on what we talked about, 1,700 units then get sold that were owner-occupied that became owner-occupied.
They might not have become owner-occupied.
Okay, so we don't know the answer.
We don't know that they on the second end are.
Okay, that's my question was going to be is maybe we're seeing a slowdown in velocity in the market just because people have just bought homes in the last year or two. Or they just refinance and they're not in the mood to buy or sell a home for 5-7 more years.
I do think that there is a significant number of people that are they're no longer buying for, it sounds bad, entertainment, right? They aren't buying for a luxury. They're buying or selling because they have to.
Right.
Because it's a better financial situation than they're currently in.
Right.
It's tough to get a better financial situation than if you bought in the market in general in the last 2 years.
Right.
Like, unless you bought a property you don't like. And then you are selling and you're buying something else, but that's a very small percentage of the sales, right?
Right.
Most of my clients that are buying residential, I mean, they're buying because whether the interest rate is 6 or 8, it's better than their alternative, whatever their alternative, whether they're renting or they're living with parents or they're, in a different state, that's what they're coming here to buy.
Right. And again, I think it ties back to which we talk about a lot too, and I still think this is something to be said. I always try to track the velocity of the market too, and by velocity, just wanted to clarify, when I track the velocity of the market, if there are 1,000 apartment buildings, and of that 1,000, 70 of them transact in a year, that's a 7% velocity. Or if only 50 of those properties sell have 1,000, it's a 5% velocity. So I track the velocity of that, just see how much money's moved through the system, which money through the system actually does create inflation if you actually follow monetary policy enough. Anyway, but I do track that a lot here, and I think to your point earlier, a lot of these houses were flippers still too. People that bought it a couple years ago, and it was just like they were seeing this run up in pricing, and it was just time to get out. I think that's been one thing that we've seen a very heavy in Des Moines. I've seen a lot of apartments too. We've seen a heavy velocity in our market that we have not seen since 2006 and 2007.
Yep. And so if you're a residential homeowner or you're buying that, another word for the velocity is days on market, right? So a lower days on market means a higher velocity.
Right. And this is where I want to talk a little bit about every summer recession right now. And I'm not getting into the details whether we are in recession, we aren't in recession, whether we're going to, or whether we're not. We'll keep that for another conversation point. But
is there people that think we're not?
It's the people. There's this. We'll get into that debate later. But if you're literally taking water out of a fire hose and it's shooting out at 100 miles an hour, and all of a sudden you start pulling that water back and it's only coming out at 40 miles an hour, that's still a pretty heavy flow of water coming through that fire hose, but it doesn't feel as heavy as it was. So when we say that we are slowing down, we are slowing down. That's exactly, the velocity is slowing down because we just saw this huge velocity come, like you just said, 700 to 1,700 units. As I said, 200 million to 500 million of sales volume. We've seen a huge velocity in the last year and a half. And so when everybody says we're slowing down, we are slowing down. And whether in recession or not, we can debate that later. I'm sure we can as well. But again, we've just seen a massive slowdown. And it's the Federal Reserve raising interest rates. It's people who have finished refinancing, I think. Investors who have refinanced. And again, I think also there's still some room to make money, especially in a single family, I think. Because like you just said, I think
the place to make money is increasing rents, providing a quality product because people have money to pay for them. Right. Like, I'll just argue that all day long. the rents in Des Moines based on your income, your standard income, is very, very low.
Right.
Percentage of your income. Well, no matter where, almost no matter where you're at. If you're, yes.
The other thing too to think about here, and this is something that people always forget, and this is just one piece of data, so don't bury me on this for everybody's watching. But yes, interest rates are high. But if you compare interest rates right now at 6% to the annual inflation of 6 or 8%, you're actually still making money buying a house right now.
And if you think inflation is actually 8%, there's another problem.
Right. Well, that's the whole point. But if you look at your actual borrowing costs compared to inflation, you are actually still underpaying for the property right now, and you're making money for inflation. That's the problem. Now, the problem is you're making money this year. What happens if inflation did drop to 4% next year, 3%, and they do taper off? That's a whole other debate.
If that happens, the interest rates will go down.
Right.
Your mortgage
they should fluctuate. Yes. They'll refinance.
Yes.
But that's why, again, we're still seeing enough buyers in the market who are saying, you know what, I'm okay to pay a higher rate because inflation is this, and it's still a hedge against what is. And that's what's creating, I think, some of our buyers still buying in the market is they're saying, I'm still hedging against inflation. I'm still not underwater. I'm still not going to borrow at a 6% interest rate and the rates are at, or the inflation's at 4%. That would completely destroy the market. Yeah. Now, I will say, that's what the Federal Reserve's trying to get us to. They're trying to get us to that point where they're either they're even, or there's one or the other, so it slows everything way down. But that's why we're still seeing some of the steam in the market from what I can tell.
Yeah, the interest rate, the more I've studied this, because I've never been in a higher raising interest rate market. Mm-hmm. I'll be honest, I've never. So I've tried to study and research and listen to people that talked about it. Mm-hmm. And the brass tacks of it is you buy a property at 6%, and if it goes down, you just refinance at the lower interest rate.
Right.
And if it goes up, you're freaking happy at 6%. Like,
so it's funny you say this because...
Are you kidding me? That only makes sense. And I didn't think about it that way, but that makes complete sense.
So it's funny you say this actually because I remember someone said to me years ago, they said, as a real estate agent, this is more for us, but it kind of ties to what you said, you only make money when markets stay at the very bottom or very top.
What do you mean? What do you say?
As an agent, you only do not make money. You lose money as a real estate agent when the market's at the very top or the very bottom because no one's selling or no one's buying, right? So here's the point I make with interest rates. When rates are ultra zero, then you really basically can't win because if the rates are zero and they go up, you win. But if they go down, then they really can't go any further. If you're already at zero, you can't go any lower. So you only have a win basically set up for you. If rates are ultra high, you're automatically losing because they just are ultra high and all you can do is go down. But if you're anywhere in the middle, like you said, 6%, rates go up, you win because you're locked in. Rates go down, you win, you'll refinance. Either way, you're going to get a win.
Yeah.
Again, if they're low, you're going to get a win. If they're medium, you're going to get a win. It's only when rates hit the ultra high that they hit, which would have been 2000 or 1980s and 70s when it was at 18%. That's when you actually, in theory, lost. But you also win too because you can just refinance later on if the deal made sense. So it's like everyone wants to look at interest rates, but if you look at it any given way, you can still make money whether it goes up or down.
I think it comes down to this having a bigger picture, right? Like you don't need to win in a 2-year period in real estate,
right?
Like you shouldn't. If you do, you have a job in real estate instead of an asset,
right?
You know what I mean? I struggle with that too because I get it. You don't ever want to look at your portfolio and say, "Shit, I shouldn't have bought 2 years ago."
Right.
But you do that every day when you invest in the stock market, right? When it goes down, everyone is down right now,
right?
Should you have not done that? No, it was a smart decision at the time. You knew you should have bought, right?
I look at this though. Let's pull us back in here for a second. This is tying more not a conversation, but more of an investment practices here, but. Look at Warren Buffett, like the absolute godfather of investing, right? And you look at Warren Buffett, you don't sit there and pinpoint, well, in 1982, he could have sold Coca-Cola and made 20% on his money, or he could have bought and sold IBM or whatever the heck it was. You look at the global picture. Yeah. So I always say, I always joke I have, but when you look at any great investor or any great person in time, whatever it is, you'll never see a snapshot and judge them by that one day or that one trade or that one moment. You'll always judge on the lifetime of what that person or that business did or created. Does that make sense?
Yeah.
So I think the same thing ties true for investments. Like every day we get lost in, well, we're in a recession and rates are going up and what's happening and, oh my God, I didn't pay for a property yesterday or last week or last month. But if you look at long term, it doesn't really matter.
Yeah. I can't get over that fact. Just hold it, right? Don't invest money that you need tomorrow.
Well, it's something I've said to a friend of mine for years, and I've always said it. There are no mistakes in real estate. Just give me a long enough runway.
Yeah.
Give me a long enough time horizon, and we're always going to win. And that's where it is interesting, I guess, to look into that picture. Like you said earlier, back to the velocity thing. Someone who probably bought a house a couple years ago and just said, I'm going to keep it as a rental, saw the pricing get high and sold it, and they probably made money. I mean, I'd almost bet they made money if they bought in the last couple of years.
Yep.
If they bought it, if they sold in the last year, they for sure made money because it's the highest we've ever seen it.
Yep. So like another data point on the velocity. Currently, I think it was last week. We are at 1,428 sold properties.
Okay.
Right. Residential MLS listings, MLS wide.
Year to date, right?
Year to date.
Okay.
Last year, 14. Is that right? Okay, so we're just going to take a step back. My point of this is I don't remember the exact numbers. I don't think it was 14.
I'm a stats guy.
But anyway, it's higher by about 50 properties than last year.
Okay.
Year to date, same June 29th snapshot. And this is all data from Les Sulgrove. He's an agent in Des Moines that is like super master data guy, so props to him. But anyway, but the pending sales, and I've talked about this for the last 2 months, the pending sales are about 400 transactions lower than what they were this time last year.
Okay.
So what that tells us is the next 2 months, we're going to have about a 30% decrease in transactions velocity.
So we've had the same velocity
today,
2021 to 2022, but looking forward using the crystal ball, we're seeing the slowdown.
It's better than a crystal ball.
Drastically,
right?
yeah.
Because it's actual properties under contract.
Right.
And I think the number is 20% of properties fall out of contract during inspection period or whatever.
Right.
So like that gives you an idea that, I mean, there's going to be a velocity, a number of units sold slowdown.
Right.
Take a step back, active listings are considerably up, probably 30% higher than what they were last year at this time. But I think it's still just 2,000 active listings.
So the interesting
and 4,000 is like an average market. So we're still really, really, really low on inventory. And if you're shopping for residential or even investment properties, like you still are not seeing very many properties that stay on the market very long that are worth the shit.
Okay, so that actually brings up the question I was going to ask then. So if we're seeing this slowdown in velocity, have you seen any fall off on the pricing structure? I saw a stat, I think it was Business Record, that April, May was up 0.7% still for house prices. So you're still seeing...
It should have been because the closings of those...
It's passed, right? Yep. So that's what I was going to say. So are you starting to see, though, or have conversations with your investors or your sellers about pricing ahead of the market and starting to reduce things from where they were at a month or two ago for comparable sales? I mean, what do you see in that?
So my conversation with sellers is if you wanted to sell at a premium that you didn't think you could get, you're past that point.
Yep.
No one is buying that.
That's a good one.
Sorry, you should have sold 6 months ago.
Right.
That's my fault for not contacting you before that, right? And telling you this. But like we're at the top or past the top of where you're going to get just a crazy offer. You can still find an offer. It's just going to be a realistic, reasonable offer.
Ballparking it for me, and I don't have exact numbers on this here, but my gut tells me I've seen about a 3% fall off in pricing in the last 6 months. Maybe 5% on some of the worst properties that are in bad areas. But
I find that so hard to tell apples to apples.
Yeah, I mean, is there anything you could judge on that?
You can do average. I mean, I still hate it. It's so property specific.
Because you can hide in the averages.
Yes,
you can hide wherever you're at.
It's so hard.
I get that. Again, it's just my gut. There's nothing else. I mean, every property's different. Every market's different. But that's how I've seen and felt a little bit is about a slight drop. I think we have some more to go. But again, for me, back to the data, I mean, I'm just looking at straight numbers. I got exactly, I think we had 13 or 14 transactions in the second quarter for multifamily apartments. But of those 14, there were actually only 10 sales because a couple of them were portfolio sales of multiple properties from one buyer to one seller. And again, 10 transactions in a 13-week time frame is actually very low when we were seeing 1 to 2 a week in the first quarter and even previous quarter. So we are seeing still a huge slowdown in velocity in our market. Again, it's just we're seeing it right now. And again, I don't know what that means. I always relate to a car. You're going from 100 miles an hour down to 50 or 60. I mean, it's a massive drop.
I think, depends on the seller. That's why, I think if you hold out, honestly, right now, you'll still get the price that is reasonable. You're not getting overpriced. And I've seen it with multiple houses.
Right.
Multiple small multifamilies, right? If you sit there for a little bit longer, you're going to get something dang close to your asking price or what the reasonable price is.
Well, what I'm still seeing right now, and I've got a transaction I'm working on where we've held out. We had it sold once, fell apart, and what's come about is a 1031 exchange. Some of that 1031 money, and that's what's keeping alive some of these sellers too. And they're saying I'm going to hold out because you know what, I'm willing to hold out for 2 or 3 months. Let's say I'm still creating cash flow, hopefully, if I did my numbers right and I have rent coming in, and as much as you want, but hopefully you're not losing money. And they're willing to hold out, and then they're waiting for that perfect buyer. And I mean, I hate saying it, but sellers, all they need is one. All you need is one person, and they need that one 1031 buyer or that one guy's got a ton of cash in their hand that wants to pay what they want to pay for it.
Right. And so, my advice to that, too, for if you are a seller and you're going to 1031 exchange, or you're looking at properties and you see something sitting for a while, go ahead and have that conversation with that agent or with your agent to their agent and say, hey, if I sell my properties, can I put yours under contract for a little bit longer contract period, right? At the price that you want.
Yeah.
I mean, I think that's a pretty reasonable at least ask, especially in the multifamily world.
Right. I mean, I'd say right now we're seeing at least 1 or 2 properties. I might have shown you earlier this week one of my listings where it was 1031 money. And that's what it was. It was just, hey, this deal makes sense because I got 1031 and I got another one more in Orkney right now as well. And they're willing to pay maybe a little bit higher price, or not higher price, but I would say today's market price.
Right.
What might have been a little, market price a few months ago as well, maybe high today. Wrapping up, I guess, we're still seeing the 1031 money fuel the market. And so again, sellers are willing to say, I'm going to hold off. I'm going to continue. And again, the difference for multifamily as opposed to housing is that most of these sellers don't necessarily need to sell, and they can just continue to collect cash flow and collect rent.
Well, I don't think the people that needed to sell are the ones that are going to sell, right? If you don't need to sell right now, you're not going to do it because you don't know what's going on.
Right.
There's uncertainty, they say, in the market. So anyway, we'll wrap this up. Guess the topic for today was just velocity of transactions, of the market, of what we're seeing. We could talk about if we're in a recession next time, and who doesn't think we're in a recession feels like they're wrong or crazy. But if you want to get a hold of us, we do not work for the same team, but we can be reached out to. We'll put information below in this video.
Yep.
Just find us on any of the social medias. Jared, jump on his newsletter for sure. Get on that quarterly newsletter report. And then I'm doing quarterly events, just educational. Last month was adjustable rate mortgage, and that was super interesting. Didn't know this. You would have known this. Fixed rates have not always been cheaper, or adjustable rates mortgages have not always been a lower rate than fixed rates. I thought it only makes sense that a fixed rate is always going to be a little bit higher than adjustable rate mortgage.
No. Well, fun fact, if you want to get some information, we're going to talk about float rates now. Next, we want to talk about float rates in terms of investments as well, which I've had some clients advise you to much success recently using floating rates.
I don't know what that means, so yeah.
So fun fact here. Always learn something new. Okay. Anyway, wrapping up, as Dart said, find us. Just Jared Huseman, just Google me. Catalyst team as well, Katalyst. We spell it a little differently because we're weird. But Google Catalyst team, Google Jared Huseman, Google Darson Grantham. He does obviously houses and small multifamily. I do more of the medium to large multifamily. Just bring a little perspective on this differently. And we're always here to be just a resource, here to just talk about what we're seeing. Yeah,
if you have questions about the Des Moines market, small multifamily, large multifamily, in general, the investment sentiment, the economy, what the cities are doing, reach out to us. One of us can answer at least most of those questions, or at least guide you to the resources that you need to answer those questions. So.
Right, and at the end of the day, reach out to us, and this is going to be a self, fulfilling prophecy or toot on a horn, but we talk to clients and investors all day, every day. We have a pulse of the market.
Yep.
We do a good job of talking to our people. We're not one of those agents who sits there and says, I think I know what's going on in the investment world, or I think my clients are talking about. We're both active investors, and we're talking to investors every day. So between us owning property and being in the market, I think we give a pretty good pulse of what we're seeing, what we're feeling, and we can give advice based on any given condition as long as we know what you're facing.
Yep, cool. Until next time, we'll see you.
All right, see you guys.